It was the chosen one, the star pupil in NVIDIA's class of 2025, a tech rocket strapped to the engine of the artificial intelligence revolution. Since its explosive debut in April, it had done nothing but soar, climbing an astonishing 270%, leaving trails of stardust and envious investors in its wake. This was CoreWeave, the name on every tech enthusiast's lips.
But then, in the disquieting calm that follows the market's closing bell, the rocket didn't just sputter, it fell out of the sky. In a turn that was as swift as it was brutal, CoreWeave's stock crumbled, plunging a gut-wrenching 10% and vaporizing hundreds of millions of dollars in market value in mere minutes. The shockwave rippled across Wall Street, leaving a single burning question in its wake: how?
How could a company, just moments after unveiling a seemingly triumphant earnings report, suffer such a catastrophic collapse? This is the deeply perplexing, high-stakes drama of CoreWeave, the AI infrastructure titan that just served up a brutal lesson in the vital importance of looking beyond the dazzling billion-dollar headlines. Today, we are pulling back the curtain to dissect this financial paradox from every conceivable angle.
Why did a breathtaking 206% surge in revenue trigger a mass exodus of panicked investors? What is the dark secret, the poison pill hidden deep within the columns of CoreWeave's financial report that sent the market into a tailspin? And the multi-billion-dollar question that everyone is asking: is this just a temporary bout of turbulence for a future technology sovereign?
Or are we witnessing the first terrifying stress fractures and the very foundation of one of this year's most celebrated stocks? This isn't just about one company. It's about a company so pivotal, so central to the AI dream, that Sam Altman's OpenAI has staked a colossal $11.9 billion on its long-term success. The story begins on what was, by all accounts, a banner day for CoreWeave. On a seemingly ordinary Tuesday, the AI cloud data center firm, which proudly flies the banner of being one of NVIDIA's stellar portfolio companies, was having a stellar day on the stock market. Its shares, trading under the ticker symbol CRWV, confidently climbed more than 6% throughout the trading session. As the closing bell rang, it settled at a robust price of $148.75. A palpable buzz of anticipation filled the air as investors eagerly awaited the after-hours earnings release, expecting a report that would not only justify its meteoric rise, but propel it even higher into the stratosphere. And when the numbers finally dropped, at first blush, they were nothing short of spectacular, the kind of numbers that make CEOs grin and investors cheer. The company proudly announced that its revenue for the second quarter of its 2025 fiscal year had not just grown, but had exploded by an unbelievable 206% compared to the same quarter last year. The total revenue figure landed at a massive $1.21 billion. Now, let's put that number into its proper context. The sharpest minds on Wall Street, the analysts who spend their entire lives modeling these companies, had collectively forecasted revenue of $1.08 billion. CoreWeave didn't just clear the hurdle, it launched itself over it, beating the consensus estimate by an extra $130 million. The positive momentum seemed to be unstoppable. The good news continued to flow when attention turned to the bottom line, specifically earnings per share. Here, too, CoreWeave delivered a pleasant surprise. The company reported a loss of just 21 cents per share before accounting for certain one-off costs. This was, counterintuitively, a victory, because the market had braced for a slightly larger loss of 22 cents per share. So let's tally the score from this initial glance. Revenue didn't just beat, it crushed expectations. The per-share loss was smaller than feared. On paper, it was a home run, a grand slam. By every traditional metric, this was the moment for champagne corks to be popping in the boardroom and for buy orders to flood the market. The stocks should have continued its upward trajectory. But it didn't. Instead, the narrative flipped with violent force. The stock nosedived. From its triumphant close of $148.75, it plummeted a full 10%. The day's hard-won gains were erased in an instant, and then some, with the price crashing down to around $133 in the blink of an eye. The party was over before it began. What was supposed to be a celebration had morphed into a scene of confusion and frantic analysis. Investors who had been high-fiving moments before were now staring blankly at their screens, desperately scrolling through the report, asking one question: what did we miss? And what they missed was the devastating truth lurking beneath the surface of that spectacular revenue figure. It was the inconvenient, ugly truth that savvy institutional investors found and immediately acted upon. The real story, the one that truly defined the quarter for CoreWeave, wasn't about the $1.21 billion it brought in. It was about the staggering amount of money it was losing in the process. The company's net loss, the final, unambiguous figure that tells you whether a business is actually making money, clocked in at a jaw-dropping $290.5 million. This wasn't just a big loss, it was an astronomical one, nearly 50% worse than the $199 million loss that Wall Street had already grimly prepared for. They had lost almost $100 million more than even the most pessimistic forecast. The rabbit hole of bad news went even deeper. The company's adjusted loss, which is often massaged to look better, was $131 million. Compare that to the same period 1 year prior, when the adjusted loss was a far more manageable $5 million. This wasn't a company growing towards profitability. It was a company whose losses were expanding at a terrifying rate. Then came the final brutal blow: the gross margin. This is arguably one of the most important health indicators for any business. It tells you if the core business model is sound. A year ago, CoreWeave's gross margin was -1%. Concerning, but perhaps explainable for a company in high growth mode. But in this latest report, the margin had collapsed to -11%. Let that number sink in for a moment. It means for every single dollar of cloud services CoreWeave sold, it was actively losing 11 cents just on the direct cost of goods sold. The more revenue they generated, the more money they fundamentally lost. Their blockbuster quarter of selling $1.21 billion worth of services directly resulted in a gross loss of over $130 million before a single dollar was spent on research, marketing, or administrative salaries. It's a business model that is, by its very definition, unsustainable. This brand of financial investigation, the discipline to ignore the siren song of revenue growth and focus on the cold, hard math of profitability, is precisely what separates consistently successful investors from the rest of the herd. If you find this level of detailed analysis valuable for your own understanding of the markets, we'd be incredibly grateful if you'd take a moment to hit that like button. It sends a powerful signal to us to keep digging deep and bringing you the stories behind the numbers. Now, in the face of this financial abyss, CoreWeave CEO Michael Intrator stepped forward to calm the market's nerves. In the official press release, he spoke of continued momentum across all facets of the business. He rightly pointed to the unprecedented demand for AI infrastructure, a demand that is undeniably real and massive. Yet this very optimism inadvertently highlights another core problem. The demand Intrator speaks of is so overwhelming that CoreWeave cannot possibly meet it. The company explicitly states that its growth is being physically constrained by a bottleneck as old as the Industrial Revolution: access to electrical power. The advanced data centers that form the backbone of the AI world are monstrously energy-intensive, and CoreWeave is struggling to secure enough megawatts to light up all the servers its customers are desperate to use. This has created a truly bizarre and precarious situation. The company is currently sitting on a revenue backlog, that is, signed contracts for future business, worth an incredible $30.1 billion. That's $30.1 billion in promised revenue that it is currently unable to deliver. It's the business equivalent of owning the world's most sought-after restaurant with a reservation list booked for years, but having a kitchen that's constantly on the verge of blowing a fuse. This immense backlog is a powerful testament to the company's critical role in the AI ecosystem, but it's also a source of immense pressure and operational risk. So, presented with this scenario, hemorrhaging cash, unable to fulfill existing orders, what is the logical next step for CoreWeave's management? Apparently, it is to embark on a multi-billion-dollar acquisition spree. This is where the story escalates, revealing the sheer audacity of the gamble the company is undertaking. Not long ago, CoreWeave closed a massive $1.4 billion deal to acquire an AI monitoring startup known as Weights and Biases. As if spending over $1 billion wasn't enough, the company is now in hot pursuit of an even bigger prize, a $9 billion buyout of a company called Core Scientific. This hyper-aggressive expansion is the definition of a high-risk, high-reward strategy. In one light, it's a brilliant, forward-thinking move. By snapping up critical components of the AI infrastructure supply chain, CoreWeave could be constructing an unbreachable fortress, a vertically integrated empire that latecoming competitors will find impossible to assail. In another, more sober light, it's a terrifyingly reckless bet. They are loading up their balance sheet with billions in new assets, and almost certainly billions in new debt, all while their core operations are burning through cash at a frightening pace. It's a bold vision, but one that could cause the entire enterprise to collapse under its own weight if profitability doesn't materialize, and fast. The sheer drama of this situation is not lost on Wall Street. In a fascinating twist, just before this chaotic earnings report dropped, one of the street's most influential analysts came out with a roaring endorsement of CoreWeave. Mark Murphy from the financial behemoth JP Morgan published a research note that had the bulls thumping their chests. He didn't just maintain a buy rating, he dramatically doubled his price target for the stock, raising his forecast from $66 per share all the way to $135. His overweight rating was an unambiguous signal to clients: buy this company. Murphy's logic was built on the powerful, long-term narrative. He cited the undeniable, exponential growth of the entire AI sector and underscored one deal in particular as proof of CoreWeave's elite status: the 5-year, $11.9 billion contract to provide essential cloud infrastructure to OpenAI. Securing a deal of that scale with the creator of ChatGPT is more than just revenue. It's the ultimate validation. And yet, Murphy is no Pollyanna. Woven into his bullish thesis were several critical caveats, warnings that now, in hindsight, seem eerily prophetic. He explicitly cautioned clients about CoreWeave's high levels of debt, the inherent volatility of its service bookings, and the single greatest long-term threat it faces, the inevitable erosion of its primary competitive advantage. For the last couple of years, CoreWeave's ace in the hole has been its privileged relationship with NVIDIA. It received early and priority access to NVIDIA's top-of-the-line GPUs, the silicon brains that power modern AI. While competitors were stuck on year-long waiting lists, CoreWeave was building. But this moat was never going to last forever. As NVIDIA continues to ramp up its formidable production capabilities, these once scarce chips will become more democratized. Competitors will catch up, getting their hands on similar hardware. Once that happens, the basis of competition will shift from access to price. It will become a brutal commodity market, leading to price wars and a race to the bottom on margins, a horrifying prospect for a company that is already starting at -11%. So we are left staring at a corporate paradox, a company with world-changing demand and catastrophic losses, a business at the heart of the AI revolution that is simultaneously being crushed by its own success. Is CoreWeave the second coming of Amazon, a company that strategically bled money for years to build an unassailable global monopoly? Or is it the Icarus of the AI age, a company flying high on the hot air of market hype, destined to have its wings of venture capital melt away, revealing a business model that was flawed from the start? The market's vicious after-hours verdict shows that fear is currently winning, but the $11.9 billion question remains. The CoreWeave saga is a defining story of our time, and its next chapter is yet to be written. To ensure you don't miss our continuing coverage of this and other pivotal market stories, make sure you are subscribed to the channel with all notifications enabled. What's your take on CoreWeave's future?
Let us know in the